Hey, good morning, everybody. My name is TJ. I'm the analyst from Maybank. I'll be moderator. Good morning, everybody. Thank you for dialing it for today's session. I'm your moderator for today's session in collaboration with Bursa Malaysia. Today, under the Bursa Corporate Series, we have the pleasure of having the management of Hibiscus Petroleum with us today to talk about the events in the oil market. But more importantly, we have the main man for Hibiscus Petroleum, Dr. Kenneth Pereira. He will be speaking on the oil market, as well as sharing his thoughts and views on the sector as well. Given the fact that oil basically barrel over $100 per barrel, something that has been unknown since 2014. So who's the better man to talk about oil and gas than Hibiscus Petroleum? So before we move on to the session, before I pass on the baton to Dr. Ken, just a brief introduction. Dr. Ken is a graduate from Bath University, UK, and he has been the managing director of Hibiscus Petroleum since 2010. So without further ado, let's give a big welcome to Ken. Over to you, Ken.
Thank you very much, TJ. Also, thank you very much to all of you who have called in on this call. Also appreciate the opportunity given to us by Bursa to do this presentation. I think just to say that present from our company, I've got here CY Yip. CY is our CFO of the company, and maybe some of you have already met him in some other forum. Also here with me is Deepak Thakor. Deepak is our VP of Economics and Business Planning. So if you have later on any questions, and you're very welcome to address some of your questions to them, so that they could answer your questions and maybe share their views too. Also here with me are Lily Ling and Andrew Fernandez from our corporate IR department, and so they will be also assisting with the questions. So just to kind of say how I'm going to kind of present some of these ideas, I've got a few slides on the company. I've got a few slides on some macro data. Maybe I'll provide some context to the industry as well a little bit. Talk about our assets and then our recent acquisition in particular, and maybe a little bit on our thoughts about the oil price outlook and how the dynamics around this industry working at this point in time, particularly with the daily changes that occur in the Russia-Ukraine situation. So maybe, and then I'll probably close the presentation with some key messages. I'll try and spend about 30 minutes at most talking, so that we have a bit of time for some dialogue after that and some questions, and maybe we can hear from yourselves. So maybe let me just start by talking a little bit about the industry. I understand that there are a wide variety of listeners today. There are some from the institutions, funds, and also some from the retail sector. So maybe a few words about the industry before I really start per se on the slides. Oil and gas are probably amongst the most important commodities in the world at this point in time. And it's really hard to imagine a world without oil and gas, as even though we look very, very aggressively towards a period of what we call the energy transition. But from the minute in the morning you pick up your telephone, you pick up your toothpaste, whatever it is, you're already interfacing with some oil and gas product. Our industry is broken down into three main segments. There's the upstream segment, the midstream segment, and the downstream segment. Upstream is where we are in, and it consists of the activities of exploring and producing oil. We look for oil, we extract it from the earth, from the ground, as efficiently and right now with as much consideration as we can towards the environment. There's also the midstream activities. These consist of transportation, storage type activities. And then downstream, we deal with the refining, marketing of the finished product. So that's really how the industry works. In the upstream sector where we operate, the main activities, like I said, looking for oil, and producing oil. And we like to think of it as being the core area of this industry, because if you cannot find it, you cannot extract it, you cannot produce it, the rest of the value chain effectively doesn't exist. So in our industry, just to give you an idea of the size of it, okay, the numbers are, I'm going to quote 2020 numbers, because this was a period of COVID, this was a period of lockdown, this was in a period of where, a period when there was not much economic activity. During this period, when global GDP was something in the range of $85 trillion, the oil and gas upstream, the E&P industry, was about $2 trillion. So we were about 2.5% of global GDP, the upstream E&P industry, about 2% of global GDP. And that was at a point in time in 2020 when oil prices were about $45 average across the year. Brent price was about 42 to 45 US dollars a barrel. And at that point in time, the value of this industry was about 2.1 trillion, actually, in that range. And global GDP was about 85 trillion. So that tells you the size of this and the importance of this industry. The largest producers in the world, and I want to just say this because then you will understand the importance of Russia. As far as oil goes, the United States is the largest producer, then you have Saudi Arabia, and then there is Russia. So Russia, and as far as oil production goes, in the top 3, top 4, they're right there at the top. And then there's the gas element of this industry. And again, the largest gas producer, USA, then Russia, then Qatar, Canada, etc. So again, Russia, very, very important, which is why now when there are geopolitical issues in Russia, we are having kind of a lot of volatility in the oil and gas space. So I think that's, and just maybe to give some local context, where is Malaysia in all of this? Well, we are the second largest oil and gas producer in Southeast Asia. We are the second largest. I think Indonesia is slightly larger than us at this point in time. But in terms of gas, Malaysia is quite dominant, okay? We are the 5th largest producer of LNG in the world. So right now, LNG prices are doing very, very well. And so the Malaysian economy will benefit from this. But Malaysia is in the top 5, and Petronas has worked very hard to make Malaysia one of the top players in LNG and gas-related businesses, okay? So just to kind of say, give you some local context. Now, with all those big players and big markets and big numbers and all of it, now we talk about our small little company, which is Hibiscus. But, we are an E&P company. So as I said, we are in the upstream oil and gas space. So we're doing exploration and production. We have a diversified portfolio, meaning that we have producing assets, development assets, and exploration assets. I'll speak a little bit more about them, these type of assets in just in a couple of minutes. But just to say, we have these assets in different parts of the world. As a company, we are listed on Bursa Malaysia, as you know, which is why we're on this presentation today. And we are also part of the Bursa FTSE for Good index, meaning to say that we work very hard at reporting all our environmental related indicators. We work very hard at that, and we also make a big effort at trying to reduce it. Okay, because to start any effort at reducing your emissions, you first got to measure it properly, report it honestly, and then you work towards reducing it, which we are doing at this point in time, using 2019, 2020 as base years. In terms of a company, you can see on the chart that is on the screen, we are a company that basically tracks Brent. Okay, you wake up in the morning, you look at the oil price, and you get an idea how our share price is likely going to perform. Once in a way, it gets a kind of a reset because we have made an acquisition, or there's been some kind of step change in one of the macroeconomic factors in the country, or whatever it is, and then there might be a bit of a change. But by and large, the company, the performance of the share price tracks Brent quite well. Okay. In terms of size, our market cap is just over 2 billion ringgit, and that was the number as of yesterday. Okay, so we've got about 2 billion shares in issue, and the share price is just over a ringgit, something in that range. In terms of our asset base, so as I said, we have producing assets, development assets, and exploration assets. We have producing assets in Malaysia, the UK, and in Vietnam. And these assets, they are PSCs in Malaysia and Vietnam. These are in production. And in the UK, we have an asset called the Anasuria cluster. And we have been producing in Anasuria since about 2016. We completed a transaction there with ExxonMobil and Shell. We acquired some assets there. In Malaysia, we've done transactions with Shell to acquire the 2011 North Sabah PSC. We've also recently completed a transaction with Repsol, and we concluded the other PSCs there. You see the PM3CAA, the Kinabalu, the PM305, PM314 assets, which were in Malaysia, which primarily in Malaysian waters, and then the Block 46 producing asset in Vietnam. So that's kind of our portfolio of producing assets. Our producing assets, as I will say in a later slide, we are producing roughly about 23,000 barrels of oil equivalent per day at this point in time. Very important, underpinning that production is about 77 million barrels of oil equivalent, what we call proven and probable reserves. These are reserves that we have in the ground. We are producing around 8 million odd barrels a year. I think that's roughly the number at the moment. So we've got about 8 years, 9 years of production that has already been discovered, connected to producing infrastructure that we are able to produce during the life and tenure of the agreements that we have with governments. So we have about 70, we have roughly about 8-9 years of production going ahead in terms of barrels already found. Then you have our development assets. We have development assets in the UK and Australia, Marigold and Sunflower being kind of our flagship asset in the UK, a lot of barrels attributed to that. And then we also have another asset called another license called Teal West, which is an opportunity, a field we have that will probably link up with Anasuria in the very near future. Kilrami is associated with a development around Marigold and Sunflower. And in Australia, we have a very small development asset, about 8 million barrels. And all of these assets add up to roughly about 73 million barrels of oil. All of this is actually oil in the ground, already discovered, but awaiting approvals, infrastructure, and some funding, capex, to make it really happen and to convert it into production. Okay, so that's about it's about 73 million barrels. So between our 2P reserves and our 2C resources, it is a company with quite a few years left in this industry. As we think is also the situation for the use of fossil fuels generally in the world, actually, right? We have some exploration assets. Some of it, the assets in the UK, we call it, we have exploration assets, but we call it protection acreage. It's acreage around some of the fields of the Anasuria cluster, because what we do is we kind of apply for licenses around existing producing blocks, so that, in the event that there is some kind of spillover, some of our fields might overlap into adjacent licenses, then we have something called protection acreage to make sure that, that we don't really get too much trouble if somebody else gets a license adjacent to us and then starts claiming oil from us, etc. So we try to put some protection acreage in place. And then in Australia, we had an opportunity to pick up some licenses. P57 is something from 2013. It's a bit of a legacy thing. And P74, something we are reviewing now to see whether there are some opportunities around that. But basically, that's our portfolio of assets in areas which are legally, we feel they have a legal framework that we kind of understand. We have the physical systems are reasonable, so we operate in these places. In most of these assets, I would say 95% of the cases for producing assets, nearly all our development assets, we are the operator, meaning to say that we manage the development plan, the production plan, the budgets, etc., for these assets. Okay, and that's a very important part of our strategy. Next slide, please. So recently, we have completed a transaction. We acquired some assets from Repsol, some licenses from Repsol in production, these licenses. And you can see, and the deal was transacted. The SPA was signed in June last year, and the transaction was completed on the 24th of January this year. And you can see the impact of this transaction for us in terms of production. It has moved us from somewhere around 8,000 barrels of oil net to us on a daily basis. It's moved us to around 23,000 barrels of oil equivalent. Our reserves have received also an uplift. This is our reserves underpin the value of the company. It's almost like a land bank, if you think about it. We've moved from about 47 million barrels to 77 million barrels, 1.6 times amount, uplift times uplift. And then you will notice that we've kind of boxed these two numbers in a kind of slightly different color because these are calendar year 2022 numbers. These are the type of numbers we are expecting during the calendar year 2022. So 8,000 barrels a day, moving to 23,000 barrels a day post-acquisition post-completion of the acquisition. And then we are also looking at our reserves being up, the uplift of about 1.6 times from 47 million barrels to 77 million barrels. To the right of those bar charts, you will see an Ebitda uplift. And here we need to kind of clarify and why they are not in the same box is because this Ebitda uplift, it's a kind of built up from some numbers that were previously disclosed in reports, and they are a little bit dated. So let's just talk about these numbers for 1 second. You can see our Ebitda number, and all of these are either audited numbers or real numbers. Our Ebitda number at 30th June 2021, the actual Ebitda number for the company without the assets that we acquired was $92 million. And then if you add it to very simple kind of just aggregated with the numbers that Repsol provided as audited numbers effective 31st December 2020. So you're adding two numbers which are not synchronized from a timing perspective, but if you do that, you will see there's already a kind of a 2 times increase in Ebitda. All right. Now, important to note that in 2020, while we are quoting $101 million Ebitda for Repsol, in 2020, as I said before, the average price of oil was around $42 to $45. That was the Brent price. Okay, so these numbers are not really super representative of where we are today. It is a $100 oil environment. We are looking at numbers that are dated. So if you can just be a little bit patient, towards the end of May, we will put out our results, and you will see you will start getting a feel of what the Ebitda numbers are going to look like in the company. And I hope at that point in time, our use of the word transformational is quite justified. Okay, the numbers we present, we already feel kind of demonstrates a certain amount of transformation in the company, but hopefully when you see the results in the end of May, hopefully it'll be an improvement on these numbers. When we bought this asset, and again, this asset was, as I said, the SPA was signed in June last year. We settled on a price of $212 million. We had to pay slightly more because there was a kind of like an interest element added to that number. About $4 million was added. So we got to a number of about $217 million as really being the acquisition price number, because we only paid for it this year, and it was a deal agreed last year. So we had to pay a time value of money type addition, which is about $4 million. But at the same time, we got a valuation of about $285 million based on a very conservative oil price deck. We got a valuation of about $285 million when we bought the asset. So a fair market valuation by a third party, RPS Energy, gave us that valuation of 285. So there was a significant kind of opportunity there, and again, on a very, very, let's say, conservative price tag. It's an asset that's been producing for many years, since the late 90s. It's a strong cash flow generating asset. And very important to note that when this transaction was done, the effective date of the transaction was 1st January 2021. What that means is that all revenue and risk from 1st January 2021 accrued to us. Thankfully, it was revenue accruing in an increasing oil price environment. So we have benefited slightly from that, as you can see from the next box, how we paid for this asset. We paid for this asset, the 217 million, the money came from the asset itself from 1st January 2021. That was $78 million. The asset contributed towards its own purchase consideration. That was $78 million. We had existing, let's say, credit facilities, a prepayment facility, and some internal cash. We had $92 million in the company from that. So, and we raised some equity in 2020 of $47 million. So long and short, this asset of about $217 million has been funded with $47 million of real equity. The rest came from the asset cash flows and debt credit facilities that the company had. Of course, the fields have been producing, just going down a little bit in this chart, the fields have been producing since 1997, and the licenses the Peninsular Malaysia licenses, they go on until 2027. The East Malaysian license, the Kinabalu field, it goes on to 2033. Okay. One of the interesting things about this asset is it also gives us exposure to gas. So we are now from a company that was before only 4% gas weighted in our production. We've now moved up to something like 31% gas in our production, something that is in alignment with our energy transition strategy to build a more resilient portfolio. Also, this opportunity has enabled us to increase or enhance our relationship with Petronas. We have more touch points now with Petronas. Previously, we were only dealing with the team that was in East Malaysia. Now we have also got reasons to work with the team in West Malaysia. And of course, we are also building a relationship with Petro Vietnam, ENP, and Petro Vietnam, the regulator in Vietnam. So that's really a little bit of background about this transaction. Next slide, please. This chart just tells you a little bit about what our EBITDA margins look like for assets in Malaysia and then our UK asset. You will note that, so these charts at the top, they show the brown bars show oil price that, oil prices, various oil prices that we have sold our oil at during different times of the last few years, different quarters. As blue bars show our unit production cost per barrel in the same quarter. So you can see generally all the time, in fact, we have been running at a positive cash flow. And the black bars show our EBITDA margins. You should look around the right-hand side axis. You'll see our EBITDA margins. So the thing that would jump out from these charts is that in Malaysia, the North Sabah asset, you see a reasonably stable kind of EBITDA margin in the range from maybe about 50 to 60%. That's our EBITDA margin. Irrespective of where oil prices are, you have a very kind of stable EBITDA margin. In the UK, you have a fluctuating EBITDA margin. It's the nature of the fiscal regime, the tax structures in the different countries. In Malaysia, when oil prices are low, you are protected. You've got a little bit of a floor on how low your own margins can go. When oil prices are high, you have a cap, whereas in the UK, so in Malaysia, you are reasonably well protected. You work in a certain band. In the UK, slightly different. You can really benefit a lot when oil prices are high, but you could also suffer quite a lot if oil prices are low. So that's kind of how these things are set up, the tax structures. We are happy that we have, different exposures in different places. So it kind of protects us in the good times, and it also kind of gives us a bit of upside. In the very good times, it protects us. In the bad times, in the good times, we have upside, and in the bad times, we are protected. So that's kind of the way our portfolio has been set up. Yeah, so now we're kind of just moving away from hibiscus and now talking about the environment we're in. Just want to kind of share with you some models that we have developed over the years to try and understand, how oil price kind of works. So I want to start in the middle of this thing just to kind of take you through what used to be the traditional situation, okay? How we used to see things in the early part of, generally in the industry prior to maybe, I would say, 2014. So what used to happen was, if we start in the middle of this chart, you see the little yellow triangle there. That in this cycle, let's say you were in a period of low oil price, and this thing cycle, it's cyclical. So you're in a period of low oil prices. What happens is you end up in a period of low oil prices, you do whatever you can to optimize and if you make more efficient your operations. The oil price, you're a price taker in a commodity market, so your cash flow would decline. And that environment would make you look at all your discretionary spending. You look to cut your price, you cut your costs, etc. You do whatever you can. And because you had low cash flow levels, then you would end up making small reinvestments, very, very small. You'd probably keep, you try and keep your production going. You'd keep you do things that are important for safety, integrity, but you wouldn't be doing any big capex projects. And eventually that would hurt production, and you would end up in a situation where you would have production below demand. So that's what would happen. And then that would naturally, with production falling below demand, you would have a situation of tightening supply. That itself would drive higher oil prices, which would then improve cash flow. That additional cash flow would give you an opportunity to increase your investment and reinvest. And because of that, you would go into a process of, because of everybody is kind of investing, production would grow, reserves would be found. People would then see oil, as being there being no supply constraints, and prices would then start falling again because production has outpaced demand. And in this traditional cycle, which used to operate for many, many years, we used to just see this happening, and it used to be like every 6, 7 years, 8 years, we would see this cycle kind of work its way. We'd work through this cycle. And in the traditional cycle, we would be in the place where you see the little arrow. Higher oil prices, cash flows would improve. Everybody would be going and chasing investment, putting more money into their assets, getting production levels up, and that would eventually cause its own demand destruction, and you would end up then driving your own price down. And we used to go through this in 3 or 4 times, definitely in my career. Now we are in a slightly more dynamic world, disruptive technologies, all that sort of stuff. And again, and this is how we see the model today. And we've kind of like tried to chart what's happening. So you see in the middle, the US in 2014, we had all these new technologies, horizontal drilling, fracking, etc., coming to be deployed very, very kind of, extensively in the United States onshore areas. And what happened then was, because of the amount of production that was being brought to market, production growth was so great that it was causing, there was actually no supply constraint. And because there was everybody just saw such large numbers coming out of the United States, prices dropped very, very significantly to around the high 20s to low 30 kind of level. And during this period, you would have heard that famous phrase, lower for longer, and all kinds of stuff coming out in the industry. And cash flows were really, really tight. And that, because there were tight cash flows, there were spending cuts everywhere. People were not investing. And since 2014, very low investment levels, very, very high kind of concerns about risk in this industry. Private equity, a lot of market players have been hurt, lenders have been hurt because of the volatility in the industry. And because of that, because of all the low cash flow available, the low margins available, very low reinvestment, hurting supply, and gradually oil prices started to increase. Just as oil prices will increase, and we saw it in 2019, late 2019, we suddenly had COVID. And COVID came into the picture. And even though oil prices were increasing, suddenly there was concern, lockdowns everywhere, economic activity curtailed in many places. There was then demand destruction, a lot of lack of demand actually. As people stayed at home and were thinking about the importance of health and well-being and all of it, people started looking at climate, the importance of managing emissions, and during this period, the climate change movement really got a lot of momentum, and there were a lot of climate change pressures, and you end up in a situation that a lot of production overshot demand. You would remember that in 2020 in April, we even had negative oil prices. Okay, so that's how bad it got for a little while. Now we're in a different situation. We're coming out of COVID, and all of this lack of investment and concerns about the environment and all these things that have been kind of playing on the industry for so many years and playing on the financing of projects in the industry have now kind of demonstrated, the effects are now demonstrable. We end up in a situation where production is way below what is demand. Okay, people are seeing a tightening of supply, and oil prices were going up anyway. And all of a sudden, along came the Russian kind of Ukraine problem. Okay, and as I said before in the opening slide, the importance of Russia in both the oil and gas markets. Definitely, they're second largest producer of gas. In the top 3 producer for oil, and a big exporter in both of these areas. And when the world, the global kind of community responded with sanctions against Russia and the friends of Vladimir Putin, the oil prices started showing volatility. I mean, people just didn't understand what were going to be the effects of the sanctions, how were people going to react, what was going to happen, how was Russia going to react. And so we've got into a situation where oil prices were already going up. They've got even maybe a little bit stronger. And as all of this has happened, what we've also seen is a kind of dilution in all the climate change pressures, because all of a sudden in Europe, energy security, in Europe particularly, Europe is impacted by these Russian-Ukraine issues. We see that energy security has become kind of like a prime consideration. And in our case, for example, we are in the UK, and we have been actually called by the regulator in the UK. We have been, gone to their office, and we have been told very clearly, you need to accelerate everything you're doing, and we will be a little bit more lenient on all the requirements that we wanted before. The regulator is saying this, that what we wanted to kind of manage the climate change, the net zero agenda, etc. They're saying they're going to be a bit more lenient in the interest of energy security, and in the interest of, because of these increasing oil prices, they're seeing a lot of issues on inflation. So where are we going? We're definitely a period of inflation. Fuel prices are up. When fuel prices goes up, the cost of logistics go up. So food prices go up. That affects the everyday individual. It affects voters. Governments are concerned. But the oil price itself might be, the high oil price itself may cause demand destruction. So oil prices themselves, if you look at the model on the left-hand side, eventually high oil prices do end up with people doing more work in the industry. That puts out more oil, and that eventually could also cause demand destruction. And the other thing is, let's say the curveball from left field. There are a lot of projections that the Fed is going to increase interest rates going forward this year. the interest rate increases are projected to be quite substantial, even in the next, not only the number of increases are being projected as being about 6 or 7 or something, 6 or 7, potential rate hikes. And also each rate hike could be a lot larger than was previously done and previously thought that might be possible. These might even be like 0.5% each time kind of thing. So all of this would definitely have a effect on economic activity, which again then could impact oil prices. So this is the model that we are living in. These are the factors. I'm just sharing with you what we think about. If you look at the little bars at the bottom, you will see in the traditional model, there was high correlation between oil price and economic activity. Now with with people trying to bring in more renewables and all of that thing, all that kind of the energy transition and agenda, there's also maybe they're trying to decouple oil price and gas price from economic activity. So these are the considerations we are all the time having to consider when we make investment decisions to do new projects, and when we look at when we are selling our oil and when we want to sell our oil and when we want to plan our offtakes, etc. So these are the things we look at. Okay, just to share with you. I think the next slide we're getting to, this is just a very interesting slide. We just want to tell you really that no one knows where oil price is going. This is what this slide finally tells you. What we did here is we looked at different projections from different people at different times. Okay, so you can see that we have a projection in 2018 that people did at that point in time, and that was the average Brent futures in 2018. We looked at analyst consensus. We've looked at all, 2020, what were the average, what people said was going to be, 2021, what people said it's going to be, the Rystad projection. We've looked at a whole bunch of them. Okay, and then we look at what it is today. So so the latest one, this is average Brent futures. This is a real number. If you want today to go and fix the price of oil you produce for the next 5 years until 2026 or whatever it is, you can sell your oil at these prices. What you see today is that at no time in the since 2018 has anyone yet projected oil prices to be as high as they are now. Okay, right now the projections are higher than they've ever been since 2018. Okay, since 2018, even the highest projections said it might be analyst consensus in 2018, it was saying that it was $61 is going to be the 2025 oil price. Today we are at 79. Okay, even in 2021. Okay, if you look at 2021, people were saying that the average oil price in 2026 was going to be $57. Today it's more than nearly $20 higher than that. So I think what this is just saying is all the best minds in the world really can't tell you what it's going to be. Okay, it's so dynamic now, and these things change from year to year. Okay, in 2020, you can look at the black line at the bottom. Look at 2020, hardly a year and a half ago. This is what people were projecting as being the oil price. Okay, can you imagine the Brent futures? If we had sold oil in 2022, in 2020 for 2023 delivery, if we had sold our oil in 2020 for 2023 delivery, we would be getting $48. And if we sold for 2022 delivery in 2020, we would have got $47 when oil was actually $101. I think we would be feeling all quite ill actually. But that's where it is. We didn't sell, thank you. Okay. Next slide, please. At the bottom of the chart, we just write down a few things that could potentially change oil price, could move oil prices. We talk about energy nationalism. If the US starts limiting exports, that could make a change in oil price. More investment, more underinvestment in the industry because people are generally suspicious, and the banks are not yet fully on board with funding oil and gas projects. They're slowly coming on board, but they're not yet on board. There could be cold weather, cold winters. These could potentially cause increases in oil price, and of course, geopolitical tensions. This also, I mean, mostly we think they're factored in, but there could be some more. Again, you could also have some drops in oil price, because you could have what's called domestic market obligations. In other words, governments wary of inflation might say you have to sell a certain amount of oil in country at a certain price. That could impact oil price, could cause localized drops in oil price. You could have another wave of the pandemic. OPEC could break up and everybody go and do their own thing, and the so-called quotas could they're all now working to quotas. That could change. Of course, we see the shale activities are increasing, but not as aggressively as people thought they might, but it is increasing. So there could be a reincarnation of such activities. There could be large-scale geopolitical tensions because this Russian-Ukraine thing erupts, something in the Middle East. The US could release more sanctions. They're talking about releasing Venezuela. Iran is imminent. I think the market is factored in Iran, but Venezuela again. Then there could be, of course, technological breakthrough in the renewable space, and the US has got a large strategic reserve. But I think in times of, where there are big geopolitical issues going on, I don't think they're going to make large releases of their strategic reserves. So these are some factors that could change oil price. Here, this is just something we're going to spend 2 minutes on. Where could oil price go because of the Russian incursion of Iran? So we just share with you the Rystad projection. This is about 2 or 3 weeks old, and it may not be entirely, entirely, let's say, relevant. But they were saying that if things took their full course and all the Western countries stop importing crude oil from Russia, then you could end up with very high oil prices, maybe up to over $200 a barrel. And in the worst case, let's say it was quite manageable. Western countries only marginally reduced their imports of Russian crude, then it could still be strong in the $100 range, but it wouldn't go kind of shooting through the roof. And we are thinking, our own opinion is this is kind of where we think it's going to be. No, it doesn't really. There are some unknown factors, like the Russians have recently, in the last few days, said that if you want to buy Russian oil or gas, the Europeans, unfriendly countries, have got to pay in rubles. They've come up with some kind of idea to prop up their currency. I don't know how that is going to be received. Of course, the Europeans are saying no, they're not going to pay in rubles. They're going to continue paying in euros. That is what they're contracted to do. But again, you just don't know how. This is just an evolving thing. But this is roughly where oil prices are. Just to say that, $100 oil is a very comfortable space for our company. It's much more than what we've ever seen during the time that we have had production. And on top of the $100 kind of price range, Malaysian oil in particular gets a good premium on Brent. Okay, we are looking at now maybe I think about 5% premium, about 5% premium. Yeah, so when you see $100 oil, we are probably selling at 105, that kind of thing. So Malaysia, the quality of the oil, particularly the Labuan blends, are very well, they are very well received by the refineries, and they pay good premiums for those. Okay. I think this is my last slide, just to say that a little bit more about Hibiscus, just to kind of give you a flavor of where we're going. During the first 2 quarters, we have reported our financial year ends on the 30th of June every year. So we have already sold in the first 2 quarters about 844,000 barrels of oil from just North Sabah and Anasuria. Our target from these 2 assets for the remaining 2 quarters, we expect to be able to deliver about a base volume of roughly combined of the 2 assets, including the 843,000 barrels already delivered. We're going to be in the range from these 2 assets about 2.5 to 2.7 million barrels. So that's going to be the range from the original assets. Then the Repsol, what we acquired from Repsol, we think we will add another roughly 2.5 million barrels of oil equivalent to that number. So we will end the year around 5 million barrels of oil equivalent, our year end being 30th of June. Okay. Remember, just a kind of note that we we would have had 5 months of production from the Repsol assets, because we only completed the transaction on the 24th of January, and our year end is the 30th of June. We think we showed you some EBITDA charts just now, but we think the strengthening of oil prices will strengthen our EBITDA margins definitely. Last year, even though oil prices were much lower, we did declare dividends, and then subject to board deliberations later this year, we hope we will be able to continue that trend. Okay, and hopefully that will continue as a policy of the company. We have done a lot of work in the energy transition space. We have our sustainability. If you read our sustainability report in our annual report, you will notice that significant improvements have been made to our emission numbers. So we are in the scope 1 and 2 numbers, and then if you look at it, you will be able to see that the numbers, big numbers reductions have been made. I think right now the important thing that we're doing, make sure that we transition the new assets into our kind of into our work culture, our work ethic, get some safe and efficient operations going. Kind of get everybody motivated to do very well, make sure that the high oil price doesn't cause complacency in our organization, and that we are still very, very kind of cost conscious and maintain our financial discipline. I think what I'd like to do is just end there for now, and maybe TJ, maybe you can take some questions.
Thanks, Ken. Thanks for the presentation. We'll now head on to the Q&A session. You can post your questions by typing in your questions in the Q&A box. You will get Ken to answer that. As you are typing your questions, I have a few questions. Ken, now, can you remove the geopolitical risk from the equation? Where the oil price split will be for the next 1 to 2 years? And do you think this cycle, the supply disruption which is caused by the underinvestment, is going to be a prolonged issue, or do you think that this can be addressed over the next 12 months?
Yeah, okay, so maybe the first part. I read in the last few days on the website oilprice.com, they had been looking at what they thought the effect of peace talks between Russia and Ukraine would do to oil price, and they felt that the impact was about $2 to $3. That was the premium. Looking at how things are now, looking at actually how you got to look at it is actually a zero-sum game at this point in time. The oil that Europe may not take will probably go to markets, friendly markets of Russia, that is China and India. And it's going to be swings and roundabouts is how I look at it, because China and India will continue to take oil from Russia, potentially at some kind of discount. So they will take that. And oil that is normally provided to China and India from the Middle East will effectively go to Europe. Okay, so that it's just going to be just a kind of a reset of some supply, your supply channels. But from an underlying perspective, there's only so much being produced and so much required. And that is what is going to keep the oil price in a certain balance. Okay. Every year, every month, OPEC is releasing larger and larger quotas, 400,000 barrels every month. But what you are seeing is that the producers under this OPEC arrangement aren't able to deliver on these quotas, and the compliance to these quotas are just increasing, or the over compliance to these quotas just increasing from month to month. At the beginning of the year, it was 116%. At the end of last month, it was 130%. So it's going up and up and up. So I would just say that I think, and the people who have looked at the elasticity or the sensitivity, being brought about by the aggression, the Russian aggression in Ukraine, they say it's about $2 to $3. That is it. So that's the first part of your question. And can you kind of tell me a little bit more about what you are looking for in the second part of your question, TJ.
The second part of the question is that do you think that this supply under investments is going to be a prolonged issue that can't be addressed over the next 12 months, and hence oil price will probably stay for the time being?
Yeah, so I think here the banks are going to have to play a big role. I think that there is going to be serious support required from the lending institutions if you want to bring oil prices down. At the end of the day, if the banks have all these ESG concerns and very high standards to meet, etc., many banks have kind of just said they're not going to support fossil fuels. If they continue that, then every bit of investment in the industry is going to be supported only by equity and maybe a little bit of lending. And at the same time, shareholders also want some return. They want some dividends also. So you're going to end up being limited in what you can do to increase production on new projects. You will be very selective, and therefore, and it's not going to be easy. Bear in mind, every day we are a country like Saudi Arabia producing 10 million barrels a day, let's say. Every year, their decline rate must be maybe 7 to 10%. So every day, every year, they have to keep a flat production profile. They have to add back 1 million barrels a day of investment, a day of production through investment. So I would say the maintenance capex, the capex just to maintain a flat profile, is already hard work for the big producers. Okay, for us to keep we know ourselves, just to keep our production profiles flat, we're spending a lot of money. And if all of this money is equity funded, where is your money coming for more reinvestment into greenfields? Shareholders want rich dividends. They want good dividends from a fossil fuel industry type player. You want to keep the oil price low, so you want to invest, but the banks are not supporting. So the banks have got to really relook whether they're going to, maybe for every $1 of equity you put in, they need to put in 150 of loans and bring down your hurdle rate so that more projects can be implemented, more liquidity in the business. So this is very, very important. Otherwise, that investment is going to be very slow.
So for the next question, before I move on to the questions in the chat box, how would an upstream company like Hibiscus navigate these sort of volatility swings in oil price for the next 5 years? What are your plans and strategies that you probably would have put in place?
We showed the chart just now, and that chart, you would have seen, we have navigated oil prices at $45. We have navigated oil prices $75. The important thing goes back to your costs and your financial discipline. You just need to, and that is why I just said to you right when I closed off the presentation, I said, the concern we have is to maintain a disciplined work culture and work ethic is what we are trying to do in a place where oil price, everybody comes and says, oh, oil price is great. We have to make sure our financial discipline is just there. We got to keep our cost structure the same, if not drive it lower. We got to make sure that, we got to plan for the day when it's not going to be so high again. So I think we got to do more of what we've been doing. Just have in our mind that the oil price is not going to be like this higher for the longest time. It's going to be high for a certain period, 2-3 years. And then it may go back to start softening, and we have to be always prepared for that. So I think that is, the most important thing now is financial discipline.
So this sort of a rising energy price, would it fair to say that is it to spend higher in terms of capex, look for opportunities, or probably take this opportunity to basically divest and monetize some of your assets that you have?
I think one of the strategies that we are looking at extremely seriously is, if you remember, I showed you the 2C resources, the development assets we had. This is not a time to be super aggressive on acquisitions, but it's a good time to look at how we can monetize the 2C resources. Marigold the resources that we have in the ground already discovered. We bought it at a low price. Now is the time to monetize it. Sell down some equity in it, put it into production. That is really what we should be focusing on, and that is what we are focusing on.
Okay, I think we'll go to the Q&A questions. I think the first question has been answered on the trading by ruble. But the second question is on, is there any opportunities to sell LNG to other regions to take advantage of higher than Henry Hub? For example, quoted Taiwan has been importing US LNG at a much higher price due to the higher transportation costs.
Yeah, so as a Malaysian citizen, I can tell you that Petronas is doing very well in this area. Okay, but Hibiscus, we are not involved in the LNG business. It's mostly in Malaysia dominated by Petronas and Shell. So the East Malaysian kind of players in Sarawak. But I can tell you that they are doing very, very well. You can see from the Petronas results. But this does not really affect us because we are not yet in LNG. We are just selling the gas, raw gas.
Okay, the next question is from Muhammad Irfan. Good sharing. At the current oil price, how will Hibiscus use the profits that they gain in such a good market now? And where is Hibiscus heading to for over the next 5 years? And how ready is Hibiscus in the energy transitions? 3 parts question.
Okay, so let me. How will we use the profits we have? Okay, so in previous years we have reinvested in our assets. In previous year, as I said, we have an opportunity to develop the assets, North Sea, etc. So there is an opportunity to do that. In previous years, we have paid dividends, so there's an opportunity for us to reward our shareholders too. So that is also an opportunity, and the board will be definitely discussing all of these points. How much do we allocate to capex? How much do we allocate to returns to shareholders? And at the appropriate time, when we really see the hard numbers, when we really understand that this period of oil prices is for an extended period, then we can kind of fix kind of expectations on dividends and all these type of things. And on the third part of the question, for the next part of the question, for the next 5 years, we have developed a 5-year mission. Our last mission statement kind of ended at the end of 2021. And that mission statement asked of us to deliver 20,000 barrels of oil production and about 100 million barrels of 2P reserves. What we achieved was about, eventually with the Repsol transaction, we achieved the production numbers, but we did not achieve our 2P number. We got to about 77 million barrels. But that was set in 2017. And so we are quite happy that we got to pretty close to achieving our mission. For the next 5 years, so we reset our mission. It is to kind of take production up to about 35,000 to 50,000 barrels, but to still keep the 2P target at 100 million barrels. So we're trying to move that the production number a bit high, not too much higher, but a little bit higher, just to kind of challenge ourselves a little bit. But the 2P number, keep it at a reasonable level, because exactly moving on to the next part of this question, we are trying to keep one eye on the energy transition. What is happening in the energy transition space? What should we be doing there? What should be our reinvestment? So we're looking at that too. So that is, and you would see in our sustainability reports we started. The big thrust will be on decarbonization, our existing assets, the emissions from our existing assets to be reduced. That's the first step. Okay, and then maybe we look at new opportunities in this space. But the first thing, bring down the emissions on our existing assets. In other words, make oil and gas, our core business, much cleaner. That's the first objective. So that's how we are working the energy transition. Okay.
On the energy transition stage, I think all the companies are basically targeting 2050 as net zero. And how is Hibiscus progressing that? And what sort of technologies do you think that will be the most realistic, commercial tool to achieve your net zero targets?
Yeah, I don't think we'll ever get to net zero from just oil and gas production. Net zero will be a combination of things, okay, and there will be definitely some offsets involved somewhere. You can't run this oil and gas operation with zero emissions. But what we are looking at are things like a lot of the assets that we have acquired, the infrastructure on board is like 20 years old, 30 years old, etc. A lot of these can be upgraded to more efficient machines, more efficient turbines, more efficient compressors. That would allow us to maybe reduce our emissions. There's also the flare gas capture projects. You know, we are always flaring a little bit of gas. Is there any way we can reuse that gas? Can we inject more into the reservoir? Can we get some of that gas and capture it in some way for use in a different way? So all of these projects are being evaluated now as we speak, because particularly in the UK, we are actually buying carbon credits. Okay, we are actually buying carbon credits because of our emissions. In fact, I would say the purchase of carbon credits, about 10% of our UK OPEX, roughly about that, right, Deepak? About 10%. So we have challenged the team there to drop that portion. How can we halve the money we're spending on carbon credits? What CAPEX improvements do we need to make? Or what operational improvements and efficiencies do we need to make to do that? So that's very much top of mind, actually.
Basically merge two questions into one. First question is on the progress on the acquisition of ExxonMobil. Your thoughts on that. And also secondly is on CNOOC announced their intention to sell its oil and gas assets in North Sea. Is Hibiscus interested?
I think you would have seen the modus operandi of Hibiscus. We buy assets when oil prices are low. So I don't know whether we would be pursuing oil and gas assets when oil prices are high. However, there are certain opportunities where we have been asked to look at a very specific set of situations, a very specific set of circumstances where maybe we may be able to kind of secure a good deal kind of thing, maybe more on a negotiated basis, that type of thing we might look at, okay? But all of these things are very, very preliminary, very early stage, and I will tell you that we are very, very sensitive about the price. The price is very high now, so we have to be very cautious if you do any acquisitions. It has to be done in very special circumstances, okay?
Okay, so that questions your on your not CNOOC's deal as well. The next question is basically on the questions of sell positions that you have now, and is there policy in place? And is this going to be a decision for Hibiscus if it ever happens?
Sorry, which question is that? I'm just looking at the question there, TJ. Which one are you?
Oh no, this is basically a random question from someone.
Okay.
First question is, what is the forward sell position now for Hibiscus? That is one. Is there a policy in place for forward selling at Hibiscus? Two, is forward selling a one-man decision? Yeah.
We at the moment we don't have a lot of barrels on a forward selling kind of program. When we have a process in the company, if we want to consider doing some fixed price arrangements, in other words, there might be some barrels that you suddenly, you look at the price today and it's pretty high, and you look at what it might be in the next 1 or 2 months. We have a process here that we kind of undertake to see whether we want to do it. That's one. Second is we would never kind of sell all of offtake. If it's 300,000 barrels, we would never take all the barrels in one go. We might just, if we want to lock in a certain price, we might lock in a certain amount of barrels. So we have a kind of a risk process look at it before we kind of think about it. But at this point in time, there is no long-term program or anything like that in place. But we do have a process. Yeah.
Okay, I'll move on to the next questions. We have seen the last quarter average realized price was below the average due to the timing of offtake. With the newly added Repsol asset, companies like Hibiscus will have more offtakes every quarter. How can you provide some guidance on the Q3's upcoming Q3's realized price for Hibiscus? Tough questions for you.
I think let me just kind of give some ideas on this. So the idea to balance out, you can never predict what the price is going to be in a particular week, because we are planning the offtake, the logistics, the tankers, and all of it. We are calling tenders from the refinery. All of this happens maybe from 2 months before the offtake. So you can never have a kind of a 2-month view. You can see how the oil prices change sometimes within 1 week. Okay, within a day, even it can fluctuate $3-4. So we are planning 2 months ahead. So the only way to do this is maybe increase the number of offtakes you have, and by having more assets like what we have now, we hope we are able to do that. We have also have co-loading arrangements, meaning to say that in the UK, we are in Anasuria, we are doing smaller parcels, but co-loading with other people. So we won't wait until we have 300 or 400, 250,000 barrels ourselves. We might sell at 100,000 barrels and co-load with somebody else. Our partner Ithaca, for example, on Anasuria. In Peninsular Malaysia, we are doing it with Petco and with co-loading again. So what we're trying to do is have more offtakes during the year, but smaller sizes to kind of even out the price you get. So that's one way we are managing this risk. Okay. In terms of the second part of the question, where you're asking for what is the price, I think just wait next month. In May, when our results are out, you'll be able to see it. But obviously, this quarter, the prices are higher than last quarter for sure. The whole market has moved up, so I don't think I'm saying anything which is kind of rocket. You wouldn't expect.
Okay. The next question is pretty straightforward. Will higher gas price contribute more to your bottom line going forward from March this month, as higher quantum of incremental gas fit into the equation?
Yeah, it's becoming in the UK. Gas is becoming more and more important. In Peninsular Malaysia, I think maybe Deepak, you want to say something that the gas is linked.
Yeah, so in our Malaysia operation, which we just acquired, PM3CA which is one of the 2 prominent PSCs which we acquired. The gas price is linked with the oil price. So when gas price goes up, the realized gas price also goes up. So for example, just to give a sense, at $100 Brent price, the expected gas price would be roughly about $6.7 per MMBTU or $6.7 per KCF. But of course, as CY said, in our UK operation, although the gas quantity which we are selling is low, but gas price has gone up significantly actually. So which is also will help us in our higher cash flow from the gas operation in UK and also.
Thanks, Deepak. Questions we have. Thanks for all the questions. We'll through as fast as possible. The next is from Boon Hian. Hibiscus has been growing their 2P reserves through acquisitions, and as reserves deplete, especially Repsol's assets have limited lifetime remaining. What is Hibiscus' plan to grow their 2P reserves, and what is your estimate of reserve growth CAGR rate for the next few years? I think that will probably fit into your acquisition on Repsol, and what plans do you have over the next 12 months on that?
I think we have 2P reserves, yes, but just remember when we were doing the presentation, we also have 2C resources. And the whole effort now is to convert the 2C resources into 2P reserves. We do that by doing more technical work. We do that by getting government approvals and putting funding in place to execute the projects. Once we do that, the competent persons and the expert, the auditors will then convert the 2C to 2P. So in the UK, that's the big thrust now for doing that in the UK. In North Sabah, we are executing projects. We're taking it through the Petronas process now to take some of those 2C resources into 2P. The important thing is we have the funnel. The funnel are the 2C resources. And the 2C resources, in fact, exceed our reserves, I think, just about the same number. Okay, so quite a big, as it were, land bank in the 2C reserves, 2C resources. So the big effort right now is spend a lot of time taking the 2C resources to 2P reserves, okay, both in the UK and in Anasuria, in Anasuria and North Sabah. The other thing we have to try to do is work very hard with the regulators, that is Petronas and PetroVietnam, see whether they would consider extending the license, the Repsol assets in Peninsular Malaysia. If that gets extended, there will be additional 2P reserves added, because right now, the 2P reserves number in Peninsular Malaysia has been cut off effective date when the license expires, the license terminates. That doesn't mean there's no more oil in the ground. It means that the license terminates on a certain day, and therefore what's in the ground doesn't belong to us. So the big effort there is to sit down with the governments and see whether we can come to a landing on an extension. So these are the kind of plans to kind of work on, to increase our 2P numbers.
To your question, to your answers on Repsol, questions from Jeff Tomlinson. Do you have any surprises, positive or negative, that you have learned after acquiring and taking Repsol assets into your book?
Yeah, I would say positive was the oil prices went up quite a lot. So that was a very nice positive thing that happened. We bid this asset in a $55 environment, and today we are double that. So that's been a very nice thing that's happened to this whole acquisition. So the timing of the acquisition was right. Negative, I would say not really anything super negative that's material. The level of due diligence we did on the asset prior to taking it over was quite extensive. There were people in our company who had previously worked on the asset. These people had joined our company some years ago. So we knew where to look for things, or how to kind of, in our acquisition price, how to make some provisions for that. So nothing really super negative that we did not expect yet. In fact, I would say probably more positive. I think another positive, some of the enthusiasm we are seeing the people, that some of the people are kind of quite excited that there is an opportunity here for them to kind of, to show off their skills and all that. And in an entrepreneurial environment, our company is quite entrepreneurial. So there you go.
Okay, the next question is from Kadir Yusuf. What is Hibiscus' plan or roadmap for sustainability, and how do you plan to be net zero by 2050? Is there any new energy to tap onto?
Yeah, so when about a year and a half ago, we started looking, first thing, important thing is measure accurately, report honestly. If you don't measure it, you can't change it. So we started looking at getting our reporting in order. We started reporting and subscribing to, putting in good submissions for the FTSE for Good Index, using that as a framework to kind of improve our own performance. So we've been working hard at that. Okay. Offshore, we have been working on the unmanned platforms. We've been adding different type of technology. We use solar panels offshore and unmanned platforms. Instead of generator sets, we're using small mini wind turbines offshore to reduce our reliance on diesel-fired gen sets. So we've been doing those type of things. Now we're taking it up. We're kind of scaling it up a bit more. We're looking at the turbines. We're looking at the big compressors. Okay, anything we can do to bring in bigger, more efficient machines that come out with less emissions. We're looking at flare capture projects, gas that we generally would flare. Can we reuse it in a different way? We're looking at all of these things. Okay, we're looking at better technology, more updated technology to remove carbon dioxide from the emissions and other greenhouse gases from the emissions. So we're doing all of those things right now. And what is really very, very heartening is Petronas is also very aligned with that program. Petronas has also got a program to be carbon net zero in 2050. So they're supportive of all these things that we're talking about. So because finally we are in a PSC environment. PSC environment means that finally these projects that we want to undertake to improve our carbon footprint have to be approved by Petronas, and they eventually pay for it. So it's good that they are in total alignment with this agenda. So we're working on that. Okay.
And the next question is on.
Sorry, I also said, like in the North Sea, we are paying carbon taxes, and we are actually financially incentivized to improve our carbon footprint there as well.
Okay, the next question is basically quite a similar one from Vijay. Is there any, do you have any plans on CCS?
Yeah, so it's an area that, we find kind of interesting. We have certain, let's say, beliefs, okay? We believe that if you really wanted to address net zero, okay, if you want to really address net zero without paying money to kind of, keep trees planted or whatever, if you wanted to do really something very, very significant, then carbon capture is something that you really have to look at. Okay, that's going to be the only way to get to a net zero type situation. So it's an area that we are studying in great detail, I must say. Okay, we're really studying the technologies, carbon capture, the economics around carbon capture. What does it take to make it happen? We're spending a lot of time on it, and it is an area I personally feel. I mean, this is just something we feel as a team actually, that when you look at all the different things you can do, wind technology, solar technology, all these different things, EV and all of that, the thing that really would make a big difference is if you can really economically do carbon capture projects. So it's an area that we really are looking at. So yeah, I don't want to say we have any firm plans, but we are definitely studying it deeply. Okay.
Okay. On your Repsol assets, will CapEx intensity increase as Repsol's assets age, and the additional CapEx be justified as the PSC for Repsol expire around 2032?
Yeah, so this is a very it's a good observation. Okay, every time, what really happens with a PSC is you don't wait until the end of the PSC to kind of get it renewed. The regulator knows that you will not be investing in the asset for the last 4 or 5 years unless you get a return on your investment. So the regulator does not want you to just neglect the asset like that. So what the regulator normally does, and it's the case for let's say PM3 or whatever in Malaysia right now, the regulator will engage you early and say, look, let's start having this discussion early so that there will be no kind of gap in your investment in the asset. So they will try to provide you with the assurance early so that you can keep your capex profile consistent. You don't see a drop. Once you neglect a field for 5-6 years and then you try to get it going again, you don't spend money on the top sides, on all the infrastructure, then the cost of getting it back up to really efficient levels and safe levels is going to be seriously more. So it's better that you just keep going, topping up and keep it going. So the regulators know this, so they start the discussions early so that you are given assurance very early that if you continue investing, that extension is there. So this is how this is normally done. So we do not get in, we try not to get into this type of situation. Okay.
Okay. I think that the follow-up question is from a loyal friend of yours, Sarizal. Based on your previous comment, previous presentation, you commented on US turning into a net importer recently. can you just revisit on what the significance of this going to be? After all, US has been historical net importer anyway.
Yeah, well, I don't know whether the US is a net importer. It might be a net importer in certain areas. Yeah, the US uses about 22 million barrels of oil. It produces maybe about 15, 16 million barrels of oil, something in that range, I think, of oil. And so, yeah, I guess it is a net importer. You can look at it that way. But I think what is happening now is you can see, because of the move towards cleaner energies, if you read up what is happening in the nuclear space, okay, the US is trying, I think, what they're trying to do is to become cleaner and maybe use technologies, you know, and the most maybe available technology to them, nuclear projects. So you will see that they are planning an investment. There seems to be an aggressive look in the US now towards nuclear in the coming years. So maybe I think this net importer profile, where they relied heavily on Middle East oil, I think I think everyone is realizing from this whole thing that's happening in Russia that people don't really want to be kind of geopolitically, you know, kind of linked, dependent on other states. Actually, there's going to be more and more energy independence required, which is why, for example, the UK is saying suddenly the North Sea is really important. Until a year ago, I would just tell you, pre-COP26 in Glasgow, it was really difficult to get approvals in the UK. It was very, very difficult. You know, the hurdles were high. Now it looks like some of these are being relaxed. It looks like in the name of energy independence, energy security, I think you will see more and more of the countries trying to shy away from being net importers of energy, whatever form, actually, because people understand that, you know, energy is kind of like the catalyst of all your economic activity. So you really need to be as self kind of sufficient as possible.
The next question is based on Repsol as well. Is there any rooms to optimize your production costs?
We are working, you know, we've been on this asset now coming up to about 2 months. So we're working on certain areas. We're looking at integration, and we believe that there will be some scope to drop our OPEX costs. So I think you will see that in the results as we go along. Yeah.
The next question is on share buybacks. Any plans for that?
No, I think all of these things will you know, will pan out as we look. Let's see how long this high oil price lasts. We believe it's going to be here for a couple of years, and these type of strategic things will be discussed at the board level, and you know, dividends, share buybacks, all of these things. We will look at the share price at the time. Let's see what happens when we start putting out quarter after quarter of results, real results, and let's see where the share price goes, and then let's decide whether share buybacks is a good idea or not. Okay.
Okay. There's something next on technical questions. On your 2C to 2P conversion, where are you in the process of converting it, and what is the typical process and timeline for it?
Okay, so different processes in different countries. In Malaysia, there is a process with Petronas to convert. You know, they call it the milestone review process. You do a certain amount of technical work, you do a certain amount of economic kind of justification, and then after this technical work and economic justification for what you want to do has been presented to Petronas, and they have several kind of rigorous reviews, a lot of scrutiny. Once this is done, you can then slowly move it to a project that has been sanctioned by the regulator, and once it is sanctioned by the regulator, sanctioned by our board for as being, you know, kind of meeting all our investment criteria, then it becomes a 2P. and then we go out and execute the project, and you will have 2P. And we are in the process of doing that for some of the 2C resources in North Sabah. We are in process to convert it to 2P reserves. So we're doing that. The same is happening in the North Sea. North Sea, slightly different process, but again, involving the regulator, involving partners. So again, you this time you justify it with partners, you get the financing in place, and then you present everything to the regulator. The regulator will kind of give you some steer as to whether they are happy with the approach you're taking. That there is quite a tough process in terms of what we call the presentation of your environmental statement. You kind of have to do a big presentation on your impact to the environment, something like an EIA, something like that. But you got to just say what is going to be your impact on the environment and how you're going to go about mitigating that impact. And when you've done all of that, you would have then got project sanction and regulatory approval to proceed with the project. And then you have also converted it into your 2C into a 2P. Again, for Marigold, we are doing that. For TOS, we are doing that as well for the TOS project. So a considerable amount of our 2C resources, we are in the process over the next, how long would I say, Deepak? 12 months? Yeah, about 12 months for all of these projects. In the next 12 months, we are moving a considerable amount of 2C resources to 2P reserves. Yeah.
Okay, next question, last few questions. What's your maintenance capex and capex now? And does it generate, on that capex question?
What is your maintenance? Okay, maybe Deepak, you want to.
Yeah, so our, if you look at our last 3 to 4 years of the operation, the maintenance capex just to maintain the facilities and the pipeline has been very, very low. In UK, it has been roughly about 2 to 3 million US dollar a year, and in North Sabah it has been about 5 to 6 million US dollars a year. But this year in 2022, as we know, in Anasuria, we are going to restore the pipeline or the riser, which we found some malfunction last year. So on that, we are going to spend roughly about 15-16 million US dollars of capex this year. So that would be kind of aberration, I would say. But normally our maintenance capex in both North Sabah and Anasuria has been very low, about $2 to $3 per barrel. That's the number. And also in our Peninsula asset, which is the Repsol asset which we acquired, maintenance capex, what we have seen in last few years has been very low. Assets are in good condition.
Thank you. I think we have come to a last 3 questions. Just a quick one. And first one, short cycles in 12 months or a longer period, 12 months, probably 2 to 3 years.
Sorry, I can't hear you very well. TJ, you're breaking up a little.
Okay, for this cycle, do you think that this is going to be a short cycle, which is less than 12 months?
Yeah.
Or?
No, I think, oil and gas projects, the period to take a project to sanction, as I said just now, it involves government agencies clearing stuff. It requires you to, just because you convert a 2C to a 2P, doesn't mean you get production. You convert a 2C to 2P and then you got to build the infrastructure. So I don't think the tightening supply situation you see will be something that can be resolved in 1 year. I don't think it can be resolved in 2 years. I think in about after 2 years, you will start seeing the impact. When you start seeing the service company, the indicator for me is when the service company performance. When you start seeing service companies starting to perform well on the stock exchange, when you start seeing all their activity levels going up, and you start reading the papers that a lot of service companies are getting a lot of contracts and they're doing a lot of work, then you know the level of infrastructure deployment offshore is happening. And then you know that there is going to be a kind of a more and more supply coming on stream. Until you see that, and I don't think we see that yet. Okay, we don't see that in the service companies yet. It takes time to call tenders. It takes time to to get projects technically mature enough to know what you need to buy, etc. Until you see the service companies starting to really show good results, that's when you will understand that, or you will know that there's going to be more oil supply coming on stream. So I don't think we are seeing that yet, and I don't think we'll see that for another good 12 to 24 months. We won't see that yet. We'll start seeing the service companies in about a year's time, and about a year after that, you will start seeing more oil in the market. So yeah, I don't think this is a short cycle problem. This is a real structural problem.
Okay. A yes and no question. Is this a sunset industry?
Is this the sunset industry? I don't think so. Even when you look at all the EIA reports and all of it, even in 2050, you look at the famous quotes now, it's coming out that net zero doesn't mean zero oil. Okay. It's still going to be a lot of oil because the energy base, the base requirement is increasing as well. And renewables.
Okay, two options here, just choose one. $100 or $150 for the next 1 year.
180.
Let me just say this, I will take both.
Okay.
Either one is okay. But as we showed in the chart before, no one knows actually.
Okay, one final question. Manchester United or Liverpool?
That one easy, Liverpool. even though I'm a Manchester United fan, that one I say is easy at this point in time. Okay.
Thank you very much, Ken. Thank you, the Hibiscus team. This has been a very engaging session. Thank you to all the questions. For your information, Maybank has a coverage on Hibiscus Petroleum. We have a buy. We have a 190 target price. Hope to see you again. Let's get the next session when things get better and we have more clarity on Hibiscus. Thank you very much.
Thank you.
Thank you.